Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Okay, so as of the close on Monday, January 26, 2026, Cloudflare, that's ticker NET, is trading at exactly 194.55. We are just hammering right up against that psychological $200 barrier. And if you pull up the daily chart, it is a massive recovery from that ugly 52-week low of 89.42 we saw last year. The technicians are all calling this a green wave 3 expansion, which, usually implies we're in the middle of a pure bullish momentum run. But while everyone is staring at the green candles, there is this massive volume anomaly sitting right underneath the surface that we really have to talk about.
The volume is strange, I grant you that, but let's be honest here. The valuation is the only number that actually matters right now. We are staring at a market cap of $66.5 billion for a company expected to generate about $2.14 billion for fiscal year 2025. That puts them at roughly 27, almost 28 times forward revenue. 27 times. That is priced for absolute flawless perfection. So the real question today isn't about the chart pattern. It's much simpler. Is Cloudflare the inevitable railroad of the AI economy, justifying a scarcity premium that just defies gravity? Or is this a stock trading on nostalgia and hype, facing, frankly, existential regulatory threats in Europe that could shatter the entire business model?
See, I think you're looking at the trailing indicators, the accounting of the past, whereas the market is pricing in a fundamental architectural shift. My position is that Cloudflare has successfully replatformed. We need to stop thinking of them as just a CDN or utility for stopping DDoS attacks. That was chapter 1. Cloudflare has become the connectivity cloud. It's the unified control plane that decouples software from hardware. The whole thesis here is about the single pass architecture. Every single server in their global network performs every single function. That creates an operational leverage that legacy competitors who have to buy all these distinct boxes for distinct functions, they simply cannot match it. And the proof? Well, it isn't just in the stock price, it's right there in the booking wedge. You look at the Q3 2025 numbers. Revenue grew 31%, which is great, but remaining performance obligations, RPO, grew 43%.
I had a feeling you were going to lean on the RPO divergence. It's the favorite stat of every growth investor when the PE ratio makes them dizzy.
Because it's the most important metric for a SaaS company, it proves that enterprise customers are signing multi-year strategic transformations. These aren't just month-to-month utility bills anymore. This is deep infrastructure commitment. When RPO outpaces revenue by that wide of a margin, 12 percentage points, it tells you the pipeline is accelerating, not slowing down.
I get why you latch onto the RPO. It is a classic bull signal, but let's contextualize the price tag you are paying for that growth. A 27.6 multiple on next 12 months revenue is astronomical in this interest rate environment. Let's look at the rule of 40, the standard efficiency metric for software, where you add your growth rate to your profit margin. Cloudflare scores a 46. That's 31% growth plus a 15% margin. And that is objectively good. It's respectable. But is it double the valuation of your peers good? I really don't think so. And while you're celebrating the architecture, I'm looking at the paradox of scale. They now power something like 21% of the entire web. That doesn't just make them a leader, it makes them a massive target. We have regulators in Italy and rights holders like La Liga in Spain attacking the core business model.
And, if the future is so bright, why did the CEO Matthew Prince just sell $30.7 million in stock this month?
We will get to the insider selling and the European regulation. I have a lot to say about Italy, but I want to stick to the market structure for a moment because you mentioned the valuation being disconnected from reality. I would argue the reality is being obscured by what's happening off-exchange.
You're talking about the dark pools?
Exactly. For the listeners who aren't staring at level 2 data all day, dark pools are private exchanges where institutions trade to avoid moving the market price. So if we look at the liquidity analysis for January 2026, we see that 44.02% of the short volume is happening off-exchange. Now, typically, when you see high dark pool volume during a consolidation range, and we've been chopping sideways between 183 and 195, that signals institutional accumulation. They are managing exposure away from the lit exchanges, the NASDAQ, to keep from spiking the price while they load up on shares.
That is a very charitable, I would say a very optimistic interpretation. Oh, the whales are secretly buying, or it suggests that institutions are managing their exit strategies without crashing the stock. Look at the institutional ownership figures. Reported ownership is sitting at approximately 109%.
Which acts as a constraint on supply. You can't buy what isn't for sale.
It's a mathematical anomaly caused by short selling and double counting, rehypothecation. But practically, what it implies is the float is effectively cornered. The available supply for retail investors is incredibly thin. When you have ownership over 100%, it means the same shares are being lent out and sold multiple times. If those institutions decide the 27 times multiple is too rich, maybe because of an earnings miss, and they all rush for the exit, liquidity just vanishes. Instantly. You don't get a correction, you get a gap down. You could see a 20% haircut in pre-market trading because everyone's trying to fit through the same door at the same time.
But you can flip that logic entirely. With 9.12 million shares sold short, and that number has risen significantly from 5.8 million in early 2025, and the stock price still pushing 200, the shorts are the ones who are trapped. The days to cover ratio is now at 3.05. For those tracking the mechanics, I mean anything over 3 is the danger zone for bears. It means it would take 3 full days of average trading volume for shorts to buy back their positions. If we get a positive catalyst in February, maybe a beat and raise on that AI revenue, those 9 million shares have to be bought back immediately. That is a powder keg for a squeeze. The high institutional ownership actually makes the squeeze worse because there are no loose shares for the shorts to buy. They have to bid the price up to infinity just to find a seller.
A squeeze is a trading dynamic, though. It's not a fundamental thesis. You're betting on market mechanics to save a valuation that the business performance can't actually support. And speaking of business performance, let's talk about the neighborhood Cloudflare lives in. You mentioned the rule of 40. Let's bring Zscaler into this discussion. Ticker ZS.
Zscaler is a great company. Don't get me wrong, but it's a different animal entirely.
It is the direct competitor in the SASE market, Secure Access Service Edge. Zscaler is the gold standard for profitability in this sector. Their Rule of 40 score is 78. 78. Cloudflare is at 46. Yet, Zscaler trades at 11 to 13 times revenue. Cloudflare trades at 27. So why should an investor pay double the price for half the efficiency?
Because Zscaler is a finished product, and Cloudflare is a generative platform. Zscaler is fantastic at what they do, secure access, but they are a maturing asset. Their architecture is based on what we call service chaining.
Explain that distinction, because I think the market, and certainly the algorithms buying Zscaler, sees them as doing the exact same thing.
Well, it's physically different. In a legacy architecture, like Zscaler's or even Palo Alto Networks, when a user tries to access an application, the traffic might go to one data center for a firewall check, then get routed to another box for a virus scan, and maybe a third for data loss prevention. That's service chaining. It adds latency. It slows things down. Cloudflare's single-pass architecture means the security check, the routing decision, and the AI inference happen on the same chip, in the same server, in milliseconds. Cloudflare secures the user, the app, and the AI model simultaneously. Zscaler primarily just secures the user. That's the premium. You're paying for the architecture that fits the AI future, not the IT past.
That sounds great on a slide deck, and I know Matthew Prince loves to tout the elegance of the code. But look at CrowdStrike. $112 billion market cap. They are the sticky endpoint security king. Cloudflare is trying to prove its platform is robust enough to displace them. But CrowdStrike is entrenched in the Fortune 500. Are you really suggesting Cloudflare is going to go in and rip and replace CrowdStrike and Zscaler in the biggest banks and governments in the world? Because CIOs are risk-averse. They don't rip out working security just because Cloudflare has elegant code.
Well, they don't have to rip and replace immediately. They just have to bundle better. This is where the Power Up Partner Program comes in. Cloudflare is winning because they bundle performance, the CDN part, with security, the zero trust part. Because of that single pass architecture I keep mentioning, their costs are lower, so they can offer a bundled price point that point solution vendors like Zscaler cannot match, because Zscaler has to pay for distinct cloud costs or hardware for every different function. It's the same playbook Microsoft used to beat Slack with Teams. Bundling wins because CFOs love consolidation, especially when IT budgets are tight.
Bundling wins if the product is good enough to stand alone and if you can actually sell it. But let's look at who they're calling for help. I mean, if their product is so dominant, why the sudden reliance on legacy partnerships? I'm looking at the Kyndryl deal. Kyndryl is a spin-off from IBM. It's as legacy as it gets. To me, this partnership signals that Cloudflare has hit a wall with enterprise sales. They can't handle the complex legacy migrations for big banks, so they have to bring in Kyndryl's consultants to do the heavy lifting.
I completely disagree. The Kyndryl partnership isn't a weakness, it's a maturation. Cloudflare has historically been a self-service, developer-focused company. You put in a credit card, you get protection. That works for startups. It doesn't work for JP Morgan. Cloudflare didn't have the sales force or the solutions engineers to go into a massive bank and spend 2 years migrating a 20-year-old network. Kyndryl solves that. Kyndryl provides the bodies and the project management. Cloudflare provides the pipes. It de-risks that 43% RPO growth by ensuring the deployments actually happen. It turns paper contracts into recognized revenue.
It's outsourcing the hard part, but fine. And what about Oracle? You view that as a win, I assume?
The Oracle Cloud Infrastructure OCI partnership is the egress fee killer. This is a brilliant strategy. The biggest problem with the cloud right now is data gravity. Amazon AWS charges you a fortune to move data out of their cloud. It locks you in. Oracle and Cloudflare teamed up to waive those fees for neutral customers. Now, consider the context. Oracle is winning a lot of GPU and AI training workloads because they have the chips. If you train your massive AI model on Oracle, you eventually need to serve it to the world. Who are you going to use to transport that data? Well, you're going to use the network that charges you zero egress fees. It positions Cloudflare as the neutral connector for the AI economy.
It's a nice narrative, the neutral connector, but let's talk about the friction in that network. You call it a connectivity cloud, but the geopolitical reality is fracturing it into a splinter net. We have to talk about what is happening in Europe. It is not just noise. In Spain, La Liga, the football league, is on a warpath. Their president publicly called Matthew Prince the narco-Maduro of the internet.
That was colorful language. Certainly. A bit dramatic, even for European football.
It's more than colorful, it's legally dangerous. Spanish courts are dismissing Cloudflare's appeals against blocking orders. They're saying Cloudflare isn't just a passive pipe, but an accomplice if they don't block pirate streams instantly. And in Italy, it's even worse. The regulator, AGCOM, fined them 14 million euros. Why? Because Cloudflare refused to comply with a piracy shield law that mandates blocking within 30 minutes without judicial review. Matthew Prince threatened to leave Italy entirely. He said he'd pull the servers.
And he should. It was a necessary stance.
But think about the economics. The single-pass architecture works because it is uniform. Every server does everything. That is how they get the margins to justify the valuation. If you have to build a specific censorship engine for Italy, and another compliance engine for Spain, and another for Turkey, your operational leverage is gone. You break the unit economics, you become a bespoke IT consultant, not a scalable software platform.
But they haven't broken it yet. The threat to leave Italy highlights that Italy needs Cloudflare more than Cloudflare needs Italy. If Cloudflare pulls out, internet latency in Italy spikes, services degrade, banks slow down. It's a negotiation tactic to protect their neutral utility status. They are fighting to remain a mere conduit under the law, like a telephone company. Verizon doesn't get sued if you plan a crime over the phone. Cloudflare wants that same protection. If they lose that, the internet as we know it changes, sure. But Cloudflare is big enough to set the terms.
That is a massive gamble for a company trading at 27 times revenue. You are betting that a tech company can stare down the European Union legal system. And frankly, the insiders don't seem to share your confidence in that gamble. Let's go back to the sales. CEO Matthew Prince sold $30.7 million in stock in early January. The CFO sold $1.7 million.
These are 10B 5-1 plans. They are automated trading plans set up months in advance to avoid accusations of insider trading. You know this.
That's the standard defense, but look at the adoption date. The plan was adopted in early 2025. That means a year ago, Matthew Prince looked at the projections and said, if we hit these prices in 2026, I want out. It sets a soft cap on the stock. When the founder is selling $30 million blocks at $190, it tells the market, I think this is a pretty good price to take chips off the table. It dampens sentiment. If he believed the stock was going to 300 next month because of a green wave, he wouldn't be selling huge blocks right now. He'd be holding for the ride up.
Founders diversify. It happens. Bezos sold, Musk sold, Zuckerberg sold. It doesn't negate the growth thesis. And speaking of unique growth factors, I want to pivot to something the bears always miss because they are too focused on the P/E ratio. Cloudflare Radar. It has become the settlement layer for the prediction markets, specifically Polymarket.
I've seen this floating around social media. It's interesting, but is it revenue or is it just a marketing gimmick?
It's brand authority, which drives revenue. Think about it. We have seen this explosion of prediction markets. When traders on Polymarket are betting on, will Iran shut down the internet by Friday? Or was the U.S. cellular outage a cyber attack? How do they settle the bet? They don't trust government reports. Governments lie or delay information. They don't trust news outlets. They're slow. They trust Cloudflare Radar data. Cloudflare has elevated itself from a utility to a truth oracle.
Truth Oracle is a very lofty title for a network log analyzer.
But it's tangible. Securing the 2024 U.S. elections gave them massive credibility. When you are the referee of objective truth in a chaotic digital world, verifying if an outage is a hack or a glitch, that makes you indispensable to governments and massive corporations. It's a secondary brand value that Zscaler and CrowdStrike do not have. Zscaler is a security guard. Cloudflare is the referee.
I'll give you the cool factor. Being the referee of the internet is powerful. But does it drive ARP, average revenue per user? I'm not so sure. And it increases political liability. If Cloudflare calls an election or a cyber attack one way and a government disagrees, they are in the crosshairs again. It brings us right back to the regulatory risk. If you are the truth oracle, you are making enemies every time you publish a report.
I see it as an absolute moat. You can't regulate away the referee if everyone relies on the referee to know the score.
We're coming to the end here, so let me just summarize my concern. The technology is impressive. I am not denying the single-pass architecture is elegant. But as an investor, I have to look at the risk-reward. You're paying 27.6 times revenue, a massive premium over peers like Zscaler, for a company that is currently in a knife fight with European regulators. The Italy model of fragmentation is a real threat to their margins. And combined with heavy insider selling from the CEO, it just feels like this stock is priced for a perfection that simply doesn't exist in the real world. At 194, the air is very thin.
And I'll close with this. The market is forward-looking. The divergence we are seeing between the RPO growth of 43% and the revenue growth tells me that acceleration is coming. Cloudflare is becoming the nervous system of the AI economy. The Oracle deal proves they are critical for AI workloads. The Green Wave 3 technicals suggest the market is looking past the regulatory noise and focusing on the dominance of the network. The regulatory fights are just proof of how important they have become. You don't regulate unimportant companies.
Well, the truth may currently be hidden in the dark pools, but I suppose we'll find out in February when earnings drop.
Indeed. The battle between the efficiency of the architecture and the friction of geopolitics continues. That's all for today.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this and leave your comments below. See ya.